Please join me in welcoming Professor Steve Keen. Thank you.
One of the questions asked you whether you thought private debt was the main driver of the economy, and the majority of you said no, it's not. I'm going to be arguing the opposite case. So I'm going to be trying to debunk a popular attitude here and see how we do with it. Because the market you're in, the industry you're in, was doing pretty well until the global financial crisis hit. That's looking at the total value of assets under management by your industry. And it's pretty damn obvious when the global financial crisis hit, and what was a fairly smooth progress, at least across the data. It's cute that it doesn't include 1987, isn't it? Okay. Smooth progress until then became very, very jerky and very volatile ever since. And what really is going on, of course, is when you attack and see where does the change come from, looking at superannuation assets and correlating change in those on an annual basis to change in the stock market, you've got a pretty high correlation with the stock market. You're basically tracking what's happening on the stock market. And the stock market went down when the global financial crisis hit, so did your assets under management. So what you're really doing is playing a game in the stock market. So the point of what drives superannuation returns comes down to what drives the stock market. And if you do conventional economic theory, it tells you that assets are driven by a trade-off between risk and return. Who did an economics degree here? Who believed it made sense? Okay, good. A few of you put your hands down, that's good. The conventional theory tells you that there's a positive relationship between risk and return. If you want to get a higher return, you have to have a trade-off more volatility in the assets you've got. And when this was first put forward by the people who developed the theory, Fama and French, well, they didn't develop it. A guy called Sharp initially developed the theory, but Fama went on a rampage as a PhD student, pushing how successful the theory was, and in his very first paper at an academic conference made the claim you can see in red there: for the purposes of most investors, the efficient market model seems a good first and second approximation to reality. In other words, it gets both the level of the stock market right, and it's right about its direction of change as well. Pretty strong statement. And also saying most of the evidence supports it and there's very little contradictory work. Well, that was then. This is now. And what I find remarkable about the teaching of economics is that there's been no reaction in the standard texts to the fact that 8 years ago, the guy who did most to push the bloody theory has now disowned it. Equally, the same person disowns it in an academic publication and defends it in public, which is quite bizarre. But if you read through this paper, which is a paper with his co-partner French in the Journal of Economic Surveys, which is one of the major journals in economics, quite a major article, and said the attraction of the model was that it offered a nice, intuitively plausible idea about how to measure risk versus return. But the empirical record is poor enough to invalidate the way it's used in applications. So if you're using a portfolio management technique which depends upon many of the assumptions of the capital asset pricing model, the guy who developed the model is telling you you're doing the wrong thing. Now, it ultimately says its applications are invalid. It should not be used. But it's still the way people are taught about how finance markets behave, and it's still a lot of what people do when they try to manage their own portfolios. So don't rely upon the academic theory, because the academic theoretician here is saying the theory doesn't make any sense. It doesn't fit the data. And what I'm arguing is the real driver of asset prices is not risk versus return trade-offs, but what's happening to private debt, how fast it's changing, and not just how fast it's changing, but how fast its rate of change is changing. What actually drives performance of asset markets predominantly is the acceleration of debt. Now, it's a weird argument, and the logic is heretical, so you wouldn't have seen it in any economics course you've done so far. But the proposition begins from saying that the money is actually created by the banks when they lend money. And the normal argument, the conventional arguments say that the banks are simply amplifying what the government does by creating what they call base money. You have the money multiplier argument. Is that a familiar term to most people here, the money multiplier? Boy, blank faces now. Okay. The conventional economic theory argues that money is created by depositors going to a bank and depositing the money, which they initially get from the government. So the government runs a deficit, or the government provides welfare checks, and the recipient of the welfare checks goes to the bank, and the bank then has excess deposits, which they can lend out. So they hang on to 10% of $100, which is $10. They lend out 90. The person who gets to the 90 deposits that in the bank. The bank then hangs on to $9 of that, lends out 81, and ultimately that $100 of government money creates $1,000 in total, with $900 being credit money. And it's arguments for money creation, but it says it's under the control of the central bank. And therefore, if you have borrowing, what conventional theory tells you is that borrowing is simply effectively also a transfer from savers to lenders, savers to borrowers. So somebody who is a saver deposits money in the bank, and the bank then funnels that money to somebody who's a borrower. So what happens, of course, is the person who saves the money can spend less, the person who borrows the money can spend more, and the two cancel each other out. Debt plays no role. That's conventional economic thinking. And to show how conventional, here's Paul Krugman. Now, he and I had a fight on the internet about 2 months ago, and in arguing against the proposition I was making that change in debt matters for the macroeconomy, he said that what actually happens in lending is that the first bit in red. If I decide to cut back on my spending and stash the funds in a bank, which lends them out to someone else, this doesn't have to represent a net increase in demand. That's his argument. That's conventional economic thinking. Well, I always prefer to ask the data than asking an economist what's actually happening. So his hypothesis, which you put in scientific terms a null hypothesis, is that private debt doesn't affect the aggregate demand, except in what he calls a liquidity trap, which is where he argues we are now. So he says normally the level of debt doesn't matter, but at the moment, because people are deleveraging, people who used to be borrowers are reducing their debt, they therefore become savers. What we need to balance it is that the people who used to be savers have to become spenders. And we can't get interest rates low enough to encourage them to do that. So there's therefore a gap in the market. That's his argument. Now, I'm saying instead that the change in aggregate debt affects the economy at all times. So here's looking at that null hypothesis. There should be no relationship, according to Krugman, in conventional economic thinking and the sort of thinking you were taught at university in how the banking sector and debt levels interact with asset markets. There should be no interaction before liquidity trap strikes, which hit in 2009. So if you look at the reserve rate in America, the interest rates charged by the central bank for bank transfers between banks and when it lends to a bank directly, that went from as high as 20% back in 1980 down to zero, as you can see, in 2008, 2009. That's what he called the zero lower bound. Now, Krugman's argument is I should find no role for debt in the economy, and therefore no role for debt also in affecting asset markets before the zero lower bound, but it should have an impact afterwards. So the question is the change in debt correlated with macroeconomic variables like the level of employment before 2009? So if the argument that debt didn't matter for employment and also debt didn't matter for asset markets is true, I shouldn't find any correlation before that zero lower bound. I should find a correlation afterwards. Well, this is graphing the change in debt versus the employment rate from 1955 through to now. And I don't need to tell you there's a correlation there all the way through. The correlation over the whole sample, let's see if I can just go back and show it again, the correlation in changes in the level of debt and, well, the level of employment correlated with changes in the level of debt over that entire time period, which is the whole, most of the post-war period, after you can regard what happened in the aftermath of the Second World War as having settled down. The correlation across that entire period is, I've gone the wrong way there, pardon me. That correlation is 0.44 over the entire sample. Now, that's including a period when the actual level of debt was quite low. Private debt back in 1955 was about 60 to 70% of GDP in America, and 25% in Australia, by the way. But as the debt level has risen, that correlation has also risen. And now if I take a look at the correlation, which is what the red line is graphing for the American economy, that correlation has risen from still a reasonable level of 0.44 to over 0.9 since 1986. Now, they're saying most of the change in employment is somehow a factor correlated or caused by change in the level of debt. So that conventional argument is clearly wrong. In fact, the correlation starts to drop the closer you get to the zero lower bound. So my argument is that it's now empirically true that demand in the economy is a sum of income plus the change in the level of debt. I've got mathematical proof that I'm not doing double counting here, which if anybody wants to get really hit around the ears by mathematics, I can do later. But I can prove that as well as making an empirical argument about it. And on the other side of the ledger, you have to look not just at demand for goods and services, but also purchases of assets. So you have a correlation or a causal link between change in debt and output and also the level of asset prices. And if I put it mathematically, I'm now saying income plus change in debt, which is the aggregate demand side of the equation, is going to be driving what's happening with GDP plus turnover in asset markets. And you can break that turnover down into the price level of assets, the quantity of assets, and then the quantity that are traded on an annual basis. And that's what that little expression does there. Now, that therefore leads, when I look at the rate of change of aggregate demand, it says there's a relationship between acceleration of debt and change in asset prices. So I'm now looking at the second differential. The rate of change of debt will be correlated to change in asset prices. So that's the heresy I'm putting forward here. Now, how strong is that relationship? Well, the best asset class to identify it with is actually households, mortgages in relationship that mortgage acceleration has to the level of house prices, because you can then identify what the money is being borrowed for. So first of all, people think there's a trend to house prices. They always rise, that's the usual mythology we're in now. This is looking at the price of houses on the most famous canal, the most wealthy canal in Amsterdam. And as it happens, the Dutch have got data going back to the tulip craze, back to 1630. Now this is the CPI deflated value of houses on that canal. And as you can see, it bounces around all over the place, but the overall trend is no trend, it's flat. But you could be born in some particular point of time and have the experience that house prices always rise and be true for the whole time you're alive. And then when you die, it goes in the opposite direction. Equally, there are periods on that line where you could actually, if I can use the laser here, the laser work or no laser working? There we go. You could have been born there and go all the way down thinking house prices always fall compared to consumer prices. On this side, there we go. So your own personal experience in an asset class like housing can be delusional over the long term. You've got to go really, really long term in your data to get an idea of what's happening. Now, even though I said there's no trend, there are definitely bubbles. And here's one that nobody denies is a bubble anymore. That's the CPI deflated value of the Case-Shiller House Index for America. And that was set when the data was reconstructed by going backwards through housing sale records, set at a value of 100 in 1890. And you can see that all the way through, it pretty much stayed about the 100, bounces around a fair bit, stays within one standard deviation over that length of time until the bubble that we now know has burst. And I've got Greenspan's name on that chart because there's an economist you can trust, eh? Okay. He told the Congress the following on the date that's marked on that chart, which I think is August 2005. Yeah. Speaking to Congress, he said, "A bubble in home prices does not appear likely." No, mate, it's bloody obvious. It's happened. When he said that statement, the change in the level the house prices got to was more than 3 standard deviations away from the long-term fluctuation. And he then said that home price declines, were they to occur, likely would not have substantial macroeconomic implications. Why does anybody listen to the bastard anymore? Yeah? Apart from stand-up comedy. Now, what they're actually driven by is accelerating debt. I'm now going to take a look at the relationship between the acceleration of mortgage debt and the change in house prices in America. And again, I think just visually, there ain't no argument, there's a correlation. It's actually 0.73, pardon me, from all the way through. I had the data more recently stronger than that. So I'm going right back in that particular chart, right back to 1955. And I'm showing that the main cause of change in house prices is whether mortgage debt is accelerating or decelerating. So if you're playing in that asset market, you're playing a game on the acceleration of debt. Now, what about the main asset class you guys are in? I'll get to that in a second, but showing the correlation, how it rises over time. Not as sharply as I showed for the employment correlation, but again, the high level of mortgage debt in America. And by the way, I was intrigued to see how few of you realise the level of mortgage debt in this country. Quite remarkable. We're investing in this area. We're affected by it all the time, and people aren't aware of the level of debt because, again, the general attitude, oh, it's not the level of debt that sets prices, it's population change and so on and so forth. Yeah. But there's the correlation rising as high as 0.85 from 2000 on between acceleration of debt and change in house price levels. Now, stock prices, well, there is a trend there. This is now looking at the trend in the real value of the S&P 500 in America versus the trend in that index to 1995. So I'm taking the S&P and I'm dividing it by the CPI, setting the value to 100 back in 1890, and then extrapolating forward. And that nice gradual exponential curve there, the blue line, is the actual trend between 1890 and 1995. I think I'm over 105 years, I reckon I'd be okay at saying that's a trend. Look where we are now. That's how much we're caught up in a gigantic bubble in asset markets, and it is bigger than any bubble in the last, well, in fact, not just in the last 100 years, in the last 1,000 years. So now what I'm looking here is how much is that divergence from the trend driven by the acceleration of debt, aggregate debt. And there's a correlation, but not a strong one, about 0.3. You can see, of course, the huge dip we went through was caused by it was correlated with, I can't say caused with a correlation that low, correlated with a massive deceleration in the rate of growth of debt in America. But I haven't been able to find this data for America. Unfortunately, I've just got to show you Australian data, which might be more useful. I couldn't find margin loan debt for America in the flow of funds. I'm going to have to go and have a better look later and see if I can find it, but I just couldn't locate their margin debt data. What I have done is it's published by the RBA. So now looking at the acceleration of margin debt and the change in the value of our stock market. There's a correlation, and a bloody strong one. So what you're actually tracking, of course there's going to be feedbacks both ways. Sometimes, of course, a rising level of share prices will encourage people to take out margin debt. And at other times, the rising level of margin debt causes share prices to rise or fall if they're going in the opposite direction. But that's the correlation. You are really playing a game, gambling on the direction in which private debt is not merely changing, but accelerating. Let that one sink in for a while. I almost fell off my chair when I plotted that. So what you've been writing, and the performance you've got for your members so far, has really been writing a historic bubble in private debt. Now, to give you an idea of just how big this bubble is, I'm going to show you the data in a second, but another unorthodox economist is getting funding from the Institute for New Economic Thinking, is a guy called Morris Schullerich. And if you want to check up and look at the data over the long time, I suggest taking his name down and checking for the research he's doing. He's got a grant to go through economic data over as large a time period as he can manage and assemble a data set across as many countries as possible. He's got to the stage of having data on either 16 countries over 140 years or 14 countries over 160 years. I keep on forgetting which one it is. But he said, looking at that data, we are living in the biggest private debt bubble recorded across that time period. And in some countries like England, he has data going back 500 and 600 years, and it's still the biggest bubble. So the period you're living through, which you think is normal, people will look back on this and regard it as the biggest financial bubble in human history. Bigger than the South Sea bubble, bigger than the 1929, etc., etc. So again, what you think is normal is one of the most abnormal times in human history. Now, here's the scale of debt in Australia over the last 150 years. The first one, the first peak there, coincides with the Melbourne land boom and bust after the gold rush of the 1880s. And according to some very good historical research by the Reserve Bank, one of the few papers I'm going to compliment, there we go, that period, as you can see, we had a higher level of debt then than in the Great Depression. The experience of Australia in the 1890s was actually worse than the Great Depression. So even the Great Depression was particularly lousy, we had a worse time in the 1890s with a higher level of debt. Well, look where we are now. Now, that's lower than America's got and far lower than England, but still historically unprecedented for us. And you can see that the whole period of the time you've been in the industry, with the minor exception of the 1987 stock market crash and the aftermath, the recession we had to have, that's been a rising level of debt to income. So you've been riding that effect all the way through in the portfolio management you've been doing. And without being conscious of it, if some of you think the actual mortgage debt level is 15%, but it's actually 86% now. So what you're going to see, now that we're going to the period now, just to go back again, just to show that chart, Australia has started to turn around in its debt level, which again appears to be a bit like these periods rather than these periods. So what you're now experiencing, and why it's been so rough since the global financial crisis hit, is that part of the underlying dynamic you weren't even taking account of, the change in debt, has gone from adding to demand to subtracting from it most of the time. But it does it in a complex way. It's not the change in debt that matters, it's the acceleration of debt. And the tricky bit there is you can actually be accelerating while going backwards. If you imagine being in a car and you're driving along and you came across a mallee bull and you put the car in reverse to get away from the bull, and then you get far enough away and you take your foot off the accelerator, you're going backwards, but you're actually accelerating once you do that. So acceleration is a complex thing to get your head around. It means on occasions there can be rallies, even though the level of debt is still falling. And that's happening in the housing market right now. So the tendency will be rallies occasionally, because acceleration will turn to deceleration and back again, but overall a tendency for deleveraging. And when you're reducing the level of debt, again, it's like slowing down. Occasionally you can slow down and accelerate, but most of the time you're going to be slowing down and decelerating. So I think the best option for somebody who's involved in trying to protect the livelihoods of Australian workers in the future through superannuation is to look for capital preservation and getting good dividend yields rather than trying to ride a rising market, because it's going to be there. I know I'm going to be rather critical of the industry. I don't know how many of you know the work of Wilson Sy, but Wilson was in the Australian Prudential Regulation Authority for some time. He's now retired, and he's taken a look at just how successful has super been as an alternative to people putting their money in deposit accounts with banks, which equally could have been done. And he said the actual returns, leaving aside the 9% people are paying in every year, the interest on those money they're saving has been less than putting it in bank deposits over the same period of time. So when he charts it, you get occasional periods where superannuation does better, but he said generally speaking, you'd be better off putting your money in cash deposits. So as an industry, it's been ineffective. And I think it needs some soul-searching. If you actually look at it, all the work, all the people, all the analysis, all the placements, and you end up being not as good as putting it in a bank account and forgetting about it. Now, Wilson's proposal is there should actually be a default option for superannuation, which basically buys a whole spread of the entire market, buys shares according to the weighting they have in the market, and therefore you simply get whatever comes out of the market, both in terms of the average dividend and the average share change. Is that that'd be safer, less work, and better return for the Australian working class and middle class than you've got out of being in super. That's depressing, isn't it? I now want to talk about I don't expect you to do that. That's going to be something which maybe comes at a policy level. I'd like to see people in industry supers pushing for something like that, because if you really do care about your members, and I know you do, in this half of the industry, your focus is the members, not the shareholders, thank God, then you can actually do something about it. But in the meantime, if you can't, what else can you do? Well, one thing in the conventional wisdom of the market, which is wrong, is that it follows a random walk. Okay? The real data follows what's called a fractal distribution. That's the sort of thing you get with earthquakes and so on, and that's a bit of a guide as to how dangerous it can be. Now, what I'm showing you here is the actual return, the daily return on the Dow Jones from 1914 to about 3 months ago. That's the actual daily change. So you can see one of them there is the good old 1987, when it fell 25% or 22% in one day. And up here we've got, back in the 1930s, there was a 15% increase in one day. That's the actual data, and that's the sort of range you need to look at to really talk about what its behaviour is. But I've taken this mean and the standard deviation of that data and said, what would a simulated data system look like if it were true that the market just followed a random walk? This is what the data would look like. And blind Freddy can tell they're different. But what it means is there are opportunities in this one, and dangers obviously, that don't exist over here. So that's what you're actually working with. That's what the CAPM tells you is happening. So anybody doing CAPM style investing is fooling themselves. This is the data set you actually have to understand. And in such a market, you can actually exploit those differences between what people think is happening and the actual data. And if you want to read a technical book on the area, a very well-written technical book, there's one by a guy called J. Edgar Peters. It's called the Fractal Markets Hypothesis. And there are trading strategies based on that, which are part of the whole algorithmic nightmare the stock market now is. So there's a possibility of exploiting that. One thing, this is also where Nassim Taleb comes in. His argument is that since that is the actual data versus what people think it is, your best situation over here is to minimise your likelihood of losing money most of the time and be prepared to make a large gain when there's a huge movement in the market, one way or the other, normally down. So that's a rather different strategy. Another proposition, I'll just show you one more thing on the simulated data here. This is looking at the simulated data over the whole time period again and imposing that actual data over the top. Now anybody could argue that's random. The reason the efficient markets hypothesis nonsense was believed in the first place is because the data range was taken with that little bit there, about 16 years worth of the data at that stage. You take a long-term look, you simply can't swallow that nonsense anymore. So any portfolio based on CAPM, change it. Now, this is now looking at one of the so-called pieces of wisdom of the CAPM, and that says that you've got a risk-return trade-off. The main question you ask people in investing, what's your risk-return profile? That's the only way the theory allows people to differ, by the way, otherwise they're supposed to be identical. But here what I'm saying is, let's look at the data itself, and this is actually from that Fammer and French paper now. So what they did was say, if the CAPM is true, then only beta and the riskless return would matter for telling you what a portfolio return was going to be. But they divided the market by book-to-market ratio from the highest decile to the lowest decile of book-to-market ratio, and then plotted that with their betas on the return chart. And that's what they got. There's the prediction of CAPM, and this is Fammer and French. Okay? It's not me, this is Fammer and French putting this chart together. The red line is a closer regression to the actual data. So far from getting an increased return by taking a higher exposure and more volatility, you get a reduced return. Your best option is to go for book-to-market ratio, go for high book-to-market ratio, low volatility. And that's the proposition which, again, if you want to work an interesting potential strategy for, there's a set of books by a guy called Bob Hagen, H-A-U-G-E-N. There's 3 of them called, he actually was a conventional, well, he looked like a conventional academic, publishing the usual stuff. But at the back of his books, he always had an appendix pulling it apart. And then he retired and thought, right, now I can tell these bastards what I really think. And he wrote 3 books, one called The Beast on Wall Street, another called The Inefficient Markets Hypothesis, and the third one called The New Finance. If you take a look at those, he argues that people, individual investors, can actually take an advantage against institutional investors by selecting portfolios like this and not getting kicked off their own board for doing so. But people who are working with a 3-month reporting cycle, unless you can get returns close to the 3-month period, not too far away from the market average, you lose your job. And if you go talking to friends and to talk about what you've bought, if you haven't bought what they've bought, you also, lose peer respect, etc., etc. That all those pressures force institutional investors, and here I'm seeing a distinction between your part of the industry and the profit-making section of superannuation. Those profit-making people are required to hit those 3 monthly returns. Now, you're not. You could actually behave a bit more like individuals in Hagen's argument. And his argument goes, you can get a portfolio where you actually statistically select it to get low volatility and high return, and then shuffle that on a 3-monthly basis to minimise your transaction costs and come out ahead. So it's a strategy that you have as a possibility that the for-profit sector doesn't have. So there's a possible way of still making money for your members in the environment we're now in by going against the conventional wisdom. So You know, one way I've also gone against conventional wisdom is housing. And here's now looking at that. I showed you that relationship between acceleration of debt and change in house prices in America. This is the Australian data. Now, we don't have quite the same powerful correlation, I'd argue mainly because our government has spent most of its time pretending to do housing schemes which are actually pseudo attempts at macroeconomic management by causing a huge injection into the economy when it needs a boost by schemes like the First Home Vendors Boost. But this is showing what's happening with mortgage acceleration in Australia and change in house prices. And if you then take a look at the correlation, again, our correlation rises to the level of mortgage debt rises. So we're now at the level of 86% of GDP in mortgage debt. It's actually risen in the most recent data. So mortgage debt's accelerating again. And because it's accelerating, we're having rising house prices. Now again, that comparison, who's got the higher level of debt, Australia or America? We have a higher level of mortgage debt than America, and we got there more rapidly, as you can see. So while the attention was on the Americans for irresponsible lending and so on, it was the Australian banks that were lending more rapidly to the household sector and increasing the leverage. We wouldn't have actually exceeded the Americans, though, if the government hadn't brought the First Home Vendors Boost in. Because you can see there, that's where we peaked before the First Home Vendors scheme came in. And then the scheme turned around a trend for a reduction in debt, which was going to be equivalent to about 3% of GDP, into a 6% increase. So that change is equivalent to about 9% of GDP being injected into the household sector, which is $100 billion. That's probably the major reason why Australia came through the crisis so well before the China bubble kicked in. So for an empirical look on economics, I'd suggest you go here and take a look away from the conventional thinking, because the conventional thinking has blinded you to the actual forces that are causing the returns you're trying to give to your members. Thank you.